everyone, welcome back to our Accounting 210. In this video, we will talk about Chapter 12, the Accounting Lab Multiple Choice Quiz, that part. So for Chapter 12, I put everything to the OneNote. Let's look at it together. Okay, so Chapter 12 basically telling you how do you spend the money, right? Capital budgeting, capital investment, and then time value of money. So general idea is it basically has two main parts. I would say the first one is using the payback method and the accounting rate of return, ARR. So both of these two methods, they do not think about time value of money. But we said, hey, $1 today worth more than $1 in the next year. Because of that, money will generate money for you, right? So it's not right to ignore the time value of money. So we have to put that in our consideration. Therefore, we would suggest using the net present value method and then also the IRR, internal rate of return method. So you definitely will have a question. You definitely will have a question for the NPV part, for the IRR part, for the present value part. As I said in the video, if I ask you one of the things, what is the most important thing in our accounting 210, I would say definitely capital investment and then time value of money is one of the most important topics. Okay, so we look at all the multiple choice and then we can review some important concepts together. Okay, I put the question solution here already, so let's look at our multiple choice part. Go to our My Accounting Lab. Let's look at the chapter 12, multiple choice. We're almost done, right? Finally, 15 questions, some multiple concept part, some calculation. So let's look at them together. Okay. First one, assume an interest rate of 14%, present value 60,000 will be it's 8 years from now will be okay. So this one asking you how do you get the present value, right? Asking you how do you get the present value. So let me get my pen ready and then I start working with you. Give me 1 second. Sorry. Okay. So this is my accounting lab. My accounting lab, the quiz part, right? Okay. The first one asking about our present value. So we said present value is your future value times the discount factor, right? Times the discount factor. And then you will get 60,000. You will get 60,000. We have to decide we should use just $1 or we should use annuity. So let's look at present value of 60,000 to be received 8 years from now. So that's just $1. It doesn't mean what's the meaning of annuity is you get this money every year for 8 years, but this one just one time, right? So we should use the present value of $1. We look at 8 years, right? Period is 8, and then rate is 14%. Make sure, right? Don't go to the other line. 0.351, right? So we time 0.351, and then we look at the answer. So this is very important that you have to make sure you know how to get this calculation present value. We focus on present value in this chapter. I know maybe if you take finance or other chapters, you have to think about future value, but we only focus on present value in this class, okay? So 60,000, don't be confused, mixed up of present value and the future value. We only look at the present value in our accounting 210. Time 0.351, we got the answer 21. Let's see whether I'm right. Yes or no. I hope it's right. Yeah. Okay, next one. Okay, next one. Put it here. Okay, next one. The next one. Okay, next one. Think about this one. What is the accounting rate of return? Question 2 asks about accounting rate of return. How do you get the accounting rate of return? It's very different. So this is the only ratio you focus on accounting. You focus on income, not the cash flow. So you have to use the cash minus the depreciation expense, right, divided by your investment. So you have to first do the adjustment. How do you get depreciation expense? It's basically the cost minus the residual divided by year, right? So this is ARR is a little bit different from other calculation based on cash flow. You have to convert from cash flow to operating income. So now let's look at this question, asking about ARR and then asking X. So your investment, now we get the denominator, is 840,000, and then you will be used for 9 years. Annual net flow is this residual. Okay, we don't need require the rate of return. We don't even think of time value of money, so don't worry about that one. But we need to. So our cash is 100,000, right? But we need to adjust for the depreciation expense. How do we get depreciation expense? Cost is 840,000 minus the residual 24,000 and divided by how many years? 9 years. So our first step is we need to get the depreciation expense. Depreciation expense is 840 minus 24 and then divided by 9 years. So we get is that what you should round to the nearest dollar. So around 91,000, right? So your depreciation expense is we just put 91,000. And then so your operating income will be 100. Hey, go. 100 minus 91. Your income is actually just 9,000, and then we divide it by 840. We get 0.1. 0.11 is this 11 is so low, right? 0.11. What? Yeah, I doubted myself, but I'm so smart. Oh yeah, my goodness. I don't know about you, but if I was a student, I would say, kind of low, but oh well, I'm smart, right? I'm smart. Oh well. Okay then. So now you got it, right? Don't doubt yourself. Trust yourself. Okay, you are smarter than Professor Song. Trust yourself. But this is how do you get ARR? How do you get ARR? Next one. Okay. So my lucky day. Let's do the next one. Let's do the next one. Okay. Next one said you win lottery and then you think what's the present value of a year received at the end of each year. In the next, okay, so you got lottery and then discount factor is 10%, asking about your present value, but this one, your present value, right? Every year you got 11,000, but what? You will get 11,000 every year for 5 years. So what we should use? We should use annuity. You will get 11,000 a year received at end of each of the next 5 years. So annuity, click the right one, right? Annuity, and then 5 years 10%, 5 years 10%, 3.791, and then I think I need calculator. I'm smart, but I still need calculator, right? Okay. Okay. Anyway, oh well, 11,000 times 3.791 gives me 41,701. Oh yeah, I'm right. Okay. So this you can see annuity and then just the one time they are different. Okay, make sure you got the right answer. Next one, the term is best described of a stream of equal installment made at equal year. This is annuity, right? Every year you get that. Okay, next one. Next one. Investment with a longer payback period. No, we wanted the payback. You lending money out. You want to get your money back as soon as possible, right? I'm not saying, yeah, I will lend out 100,000. I want to get it back after 1,000 years. No, I want to get it back next year. This is false. Next one. Okay, asking about your payback period. So how do we get our payback period? Payback period is very easy, right? Basically, I lend out $100 every year, I get 20. It takes me 5 years. So general idea is your investment divided by your cash flow, right? So you will invest 820,000. But every year you get 135,000. That's it. You don't worry about residual. You don't worry about anything else. So how many years you will get your 820 back? We just divide 35 gives me 6.07. Oh yeah, I'm right, huh? Right. Okay, next one. I do not honestly, I don't worry about the payback method. I worry more about ARR, NPV, and IRR. Okay, next one. One disadvantage of payback is it doesn't consider time value of money. And that's right, right? That's right. Another bad thing of payback is it only focuses on years, not the overall profitability. Remember that one, right? So we only care about, hey, we want to get our money back as soon as possible, while we ignore the overall cash flow, right? We ignore that one. Okay, make sure you know the bad part. The process of making capital investment decisions is referred to. Yeah, that's right. So we how do we spend money? That called capital budgeting. We budget. How do we spend the money, which is our capital? Capital budgeting. We budget how to spend the money, right? Next time, if you don't know how to spend money, just call me, okay? Email me. I'm always there for my students. Okay, next one. I'm joking. Okay, next one. Asking about your required rate of return. No, asking about your NPV. Oh, this is important, right? As I said, you definitely will have a question of NPV. I'm not saying it's very similar with this one. I'm just saying, but you definitely will have a question of NPV. How do we get our NPV? Two parts, right? So first is net, right? And then it's the present value. So we have to get present value. We have to net the inflow and outflow. So let's look at this one. Most likely I want to draw this line. So let's say you invest in this. The project would require initial investment of 31,000. So you have to spend the money. You have to spend 31,000 at the beginning of the project, right? And then project we will have a residual. Okay, we'll have a residual of 3,000. Useful life is 3 years. So T equals to 1, T equals to 2, A equals to 3. I draw too long. Okay, let me use this. Hold on. Yeah, I'm so smart. Yeah, I have a e-reader. Yeah. Okay. Don't joke too much, right? Okay. So let's go back to our work. Okay. So at the end of the year, I'll put the number first. You have a residual of 3,000. Okay. I put the number here. It's the cash inflow. This is your residual. Okay. This is your residual. I'll put it here. And then every year, used for 3 years, new projects to generate additional net cash flow in the next. Okay, so every year you will also have 22,000, right? You will have this rate of returns. Okay, so how do we get this one? First, very typical NPV calculation, very typical, very useful example. So let's look at how do we get this. So first you need to get the present value, right? Present value. So you have 22,000 end of the first year, 22,000 end of the second year, 22,000 plus 3,000 end of the third year. Many different ways to discount back, and then you have to discount, right? You have to discount to T equals to 0. So different ways to discount. I'm not going to do all the calculation, but the first way is some students said, okay, so 22,000, this is annuity, right, for 3 years. So 10%, 16%. So 16%, I'm not going to do this, but anyway, I'm going to do this. 16%, 2.246, okay? And then are we down? No, we are not down. Hey, wait. We are not down, right? We still have this 3,000. We still have this 3,000. So we have to discount back this 3,000. Very important. A lot of students make a mistake here. How do they make a mistake here? They still put the 3,000, right? So this just okay. I still put 3,000 and then time the 2.246. Is that no? This is not right, because that 3,000 actually is just one time. For that 3,000, okay, some students say, okay, I got it, 3,000 one time, so I should just use this one is easy. They already told you. Some students they use one period. That is wrong. Your 3,000 is 3 years. Right, also 3 years. So you should actually use the 3,000 time what? You should use 3,000. You should use 3,000 time. You see time 0.641. This is the right way. Okay. I'm sorry. They don't give you period 1 or period 2. You know, the other method is you discount 22,000 first year, discount 22,000 the next year, discount 25,000 the third year. Or some students, they will do 22,000 for 2 years annuity and then 25 for the third year of 0.641. But since this one only gives you 3 period directly, so seems this is the only reason. Okay, but I will post the table, discount table for you. If you have other ways to discount, you can use your method. But this is very important. This is very important. Okay, seems we only have this choice. Now we have to get the number. We have to get the number. So let's look at the number. Hold on, sorry. Okay. So let's look at the number. Let's look at the number. 22,000 times 2.246. That gives me 49. So I just use the calculator for the number. Okay. So that gives me 2 6. Okay. 49 412,000 plus 3,000 times 0.644. Oh, this is not 1,000. I already calculated 1,000. Okay. Plus 1,923. Okay. So what's the number? 49 for 12 gives me 51,300. Are we done? Do we have any choice? Hey, we don't have it. Okay, so we are not done. You know, we are not done because there is no other choice. Why we are not done? Because this is just the present value. We have to do what? One more step is we have to subtract the outflow at the beginning of the year. We have to subtract the investment 31,000. We have to subtract this one. So therefore, we will get 20,335. Okay, so that's our NPV. This is our NPV. This is just our present value. This is present value of inflow, present value of outflow. We got net present value. So our answer will be C. Okay, let's see the number. Yeah, I'm so smart, right? Now I believe I'm this smart. Okay, next one. When you evaluate capital investment, if the internal rate of return is less than required rate of return, the project will be accepted. That's wrong. So what's the meaning of internal rate of return? We kind of talk about that. We said how do we understand the logic? Okay, so you borrow money from the bank, right? So the bank said, oh, you need to pay me 10% interest. That's the required rate of return. You use this 10%, and then you get the ice cream store, you get the gas station, you get the hotel kind of. And then from this project, the internal rate of return for ice cream store, the rate is 7%. Okay, gas station is 10%. The hotel is 13%. Let's just make up a number. You borrowed 10%, but your internal rate of return is only 7%. Hey, come on, you are losing money, right? You are losing money. You definitely should not accept this project. You cannot accept this project. So we have to compare our IRR with our RRR, and our criteria is our IRR has to be larger than RRR. That means you are making money at least the same. So if you borrow at 10%, you invest, the internal rate of return for a project is also 10%. That means you break even right here, right? Break even. You don't lose money, you don't earn money. Next one, current rate of return is the only method use capital investment that use accrual. Yeah, that's the only one. All the others, they use the cash, but ERR use the accrual accounting. Okay, next one. I think we are ready to do some calculation together. Okay. So let's look at this one. I want to use maybe Rainbow. I haven't used Rainbow for a long time. Asking us about the IRR. Okay, IRR. This is interesting. We said, how do we get IRR? IRR we do not calculate. We get it from the table. We get it from looking at the table. Okay. So we have to set the equation. The equation is a net present value equals to 0. And then evaluate investment. So your outflow is 30,924. And then you plus the every year is 12,000. And then we time the discount factor. We do this, we get it's 0. So we first get the discount factor has to be 3924 divided by 12,000. So we got our discount factor is 2.577. And then we know how many years, it's about 3 years. And we look at the annuity for IRR, you look at the annuity, and then 3 years, 2.577. You got this one. You look up, okay? You look up, you found out, hey, the rate is 8%. The rate is 8%. That's how do you do IRR? How do you do IRR? Okay, next one, very important, very important. Next one, NPV and IR example discount cash flow. Yeah, that's true. We use they both based on discounted cash flow idea. Next one. Let me see. How about next one? Okay, I want to do the last one easy first. So I know I just have one more. $1 we receive in the future is worth more. No. $1 received today is worth more than in the future. Okay. Okay, we have a last one. Let's see. That person. Okay, asking my net present value. New would cost this useful for 5 years, and end of the year it will have a residual 2600. And new is this per year is 6 years. Minimum required. Hey, I leave this to you. I believe you can do it. It's a very similar with this one. So very similar with this one. I believe my students can get it. You calculate NPV, net present value, so you have all the present value. Make sure you also think about the residual, and then you net it with the initial investment. Okay, then I think I stop here. Let me know if you have any question. Chapter 12 is very, very important. So let me know. Just email me, meet me online for the Zoom, and then I see you in the exam. Thank you. Bye.